All right. Yeah, good evening. So, just do a quick introduction. So my name is Drew. And actually I'm based in Canada. So I know all of you, or most of you at least, is in Singapore. So it's 7 p.m. now, but here it is 6 a.m. So it's really early. It's pretty dark. Um, so yeah, I'm based in Montreal, Canada. And there's a background of my experience. Previously, I was working in Singapore for 6 years and have been in the corporate and investment banking space as a relationship manager and also credit risk analyst. So I actually moved to Canada to do my postdoctorate or PhD, and then now I'm working here in Montreal. So yeah, it's good to see that the class, I think we have 36 of you guys. Um, just want to check, anyone, are most of you all in year one, or are there some year twos or even year threes in our class today? Year two? Okay. Year one, year two. Oh, you have a final year one. Okay. Okay. You have a mostly, I guess I can see mostly year one, year two, and we do have one final year one, I guess year three or year four. Okay, so this class, I think for most of y'all will be the first introduction to finance because it's a required, I think it's a required course for all majors, not only finance. We have one more year three. Okay, yeah. So I think for year threes, especially if you are in more like the business finance track, you might find it very easy. But and we'll try to go a bit slow because this is more like a fundamental class for like year one, year two kind of a course. So in terms of objective, we'll go back into we go to the basics of things like what is finance. We'll cover things like time value of money, financial statement analysis, kind of risk and return, kind of calculation. So quite a bit of calculation in this course. We talk about some capital structure, discounted cash flow, and last but not least, a bit of working capital management. All right. So in terms of the textbooks and reading study guide, I would say, the textbook and study guides are very good reference material. However, if you do not want to refer to them, the lecture slides are more than sufficient, right? So if you do have some you want some more information, maybe, or you want a deeper understanding of certain topics, you can reach out to the textbook and study guide. If not, whatever we covered in the lecture is more enough for your assessment, for your project, etc. Right? So in terms of the assessment, I think this is not new. Okay, maybe for some year ones, if this is your first course, it might be a little new. But so we will do have three components. We have the TMA, right? That's your individual kind of assignment. And this will cover unit 1 to unit 3. Basically means the first 3 lectures. And then we have your group-based assignment. So for the group-based assignment, I encourage you. I have received some groups already, but I encourage you to try to form groups at least by the end of this lesson. If not, I'll just randomly allocate you a group, right? So for the GBA, we have groupings of 4. So drop me an email, whether is it between the breaks or before the end of the lesson on your groupings, right? If not, you just be randomly located a group in case you don't know anyone. So do not worry if you do not know anyone yet. You do have some time during the breaks. You can just write in the group chat, finding a group. Class participation. So because it's an evening class, usually for me, I like to be very upfront. How do you score on class participation, right? So it is, I like to be very transparent. So everyone will get 50% of the grades, regardless of whether they participate or not. Now, the other 50% is based on how much you participate in class, right? So whether is it unmuting yourself or even just type in a group chat, that's fine as well, if there are any questions. And last but not least, you have a written assignment at the end. in terms of how we break the 3 hours, usually what I like to do is we will have a break per hour, meaning that we have two breaks. So every hour we have one break, so that you can go to the toilet, or get some tea or coffee, or just have a rest right before we start the next part of the topic. Maybe at this point of time, do we have any questions, any comments, any doubts about the course, or even your groupings, assessment, etc.? No, very good. Okay. So feel free to unmute yourself, but if you're a bit shy, you don't unmute yourself to ask questions, just type in the group chat. We'll try to answer it along the way, right? So at least we have like more of an interactive session, or can kind of understand where are your doubts are, and then we can focus on those in our discussion, right? Okay, a bit more administrative matter. We will be using Excel 100% of this course. However, I think some of you might be more proficient in financial calculator, especially the BA2 plus. Feel free to use it. In the not last year, but like the year before last year, right? We do teach the financial calculator, like how to use it. But now the school has decided to stop and focus purely on Excel. So we'll use Excel as well. And in terms of financial calculator, if you do have any doubts or you do want to use it, you can reach out to me directly, and then I can go through with you, because I actually grew up using financial calculator. So I kind of know how to use it, and I used to teach it. But now there's a school decision to fully focus on Excel. Okay. All right. So, let's kickstart today's lecture. You might be a bit light at the start, but later on, there is as we end, we'll talk about financial ratios, and that portion is a little more heavy. But don't worry. So at the start, still a bit light. We kind of want to understand why do we study finance. So it can be for budgeting, it can be for accounting, management, and even personal finance, right? So, finance is in all aspect of a business, right? From course, accounting part, you definitely know finance. Management is more of like the strategic part of planning. Are you thinking about, building a new factory? Are you thinking of producing a new product? So all this relates to finance. And of course, the personal side of things, to plan for your own retirement, or even for your kid, or your own education as well. So some basic areas of finance, of course, we have investment, financial institution, and corporate finance, which is where we are going to focus on most of our discussions. So these are some examples. I'll try to go quite fast for these slides, because these are more like just introduction slides. You will not be tested. There will not be a question like, what is finance? So I'll just go a bit faster. However, when I drill down into certain concepts, that are the important parts that usually we want to focus on as well, right? So do not worry if sometimes it's a bit fast on certain areas. And I'll of course also mention to you that, okay, these are more just for understanding, and not really kind of like a area that usually is being tested. So in terms of investments, we need to consider various things like stocks and bonds, which is something that we'll learn how to calculate. How do we value stocks and bonds? That will be in the next lecture. When we think about things like risk versus returns, so this is lecture 3, and asset allocation. Unfortunately, in this course, we will not cover this. This is more of we have another course on portfolio management, where we talk about asset allocation. So we'll not cover asset allocation here. All right, there are some job opportunities if you're interested in investments. In terms of financial institutions, we are focusing mostly on banks, insurance company, and brokerage firm. Of course, there are various job opportunities there. Okay, in terms of business finance, this is where we'll cover each topic. So when we think about capital budgeting, this will be in lecture 5, right? Capital structure, it will be lecture 4. So what's capital budgeting? Basically, let's go back up. So capital budgeting is basically the idea of like, okay, I'm a company, I want to expand my plant, let's say in Malaysia, right? So of course, when you expand a plant in Malaysia and you're a Singapore company, you can't need money to do it, right? So you're planning for things like, oh, building of a office, or maybe you don't build office, or you rent an office space. So all these are like capital budgeting, things that you need to budget, and they relate to capital expenditure. Everyone, does anyone know what is the difference between capital expenditure and revenue expenditure? Or have you heard these terms before? Nope, never. Okay. Okay, so I'll try to explain to it now. So capital expenditure and revenue expenditure. So there are two different type of basic expenditure means expense, right? So there are two different kind of expense. For capital expenditure relates to things spending on items that are relating to fixed, they call it PPE, plant, equipment, and plant, property, plant, and equipment, sorry, PPE. So basically, they're anything that is like physical things. So like either you buy a new motor vehicle, right, for your business. So that is a capital expenditure. Or I think we have a comment here that creating more investments. It might not be new technology. You are that's close, but it relate to more than like yes, correct, fixed asset, right? So things that are fixed. So this relates. These are more capital expenditure. However, revenue expenditure is more of things that are more for daily running of the business. For example, utilities, right? You need lights, water to run your business, or maybe you need things like stationery, right? So stationaries, all these are considered a revenue expenditure. So these are two different. Capital expenditure, more relating to fixed assets, PPE, plant, property, and equipment, right? PPE. And revenue expenditure is more of like the daily running of the business, things like utilities, stationery, or even like petrol, right, for a car. And yes, that's right. So long-term asset, that's correct for capital expenditure. Now, going on to the next point, in terms of capital structure, so we'll have a quite in-depth discussion on what's capital structure. And to just give you an overview, capital structure is the idea of, okay, in a business, how much debt should we have, right? And how much cash should we have, right? So this, whether it's debt or cash, or maybe equity, how much equity should we have? So this composition of debt, cash, equity is the capital structure of the company, right? So we'll look in detail what does this mean. Last but not least, we have working capital management. Now, working capital management, as the name suggests, is sort of kind of capital, right? But this is not our revenue expenditure or capital budgeting or capital expenditure, right? So this is working capital. Working capital means the capital that works for you. Means what does it mean? It means the kind of daily expenditure you need in order to generate revenue, right? So I repeat again, your working capital is like your daily expenditure or daily expenses required to generate revenue. So generally, later we'll have a look at what does this mean. It means more of your current asset, your current liability, things that are current, right? It means that short term, because these current asset or current liabilities are required to generate income for your company. Okay. So there's a few kind of visions, when we think about each of the component. I earlier highlighted about, whether we should do an investment in Malaysia, build a factory there, or have an office there, or maybe it can be also a project. We look at projects. Um, Capital structure, how much debt, how much equity. Remember, we talk about how much debt, how much equity, how much cash. So you need, how many percentage. It's like a pie. So imagine like a pie. So like how much of it is debt, how much of it is equity, right? B for debt, E for equity. Yeah, so we need to determine the proportion of this pie. Working capital is more of managing the day-to-day finances. All right. So again, this one I might go a little faster because forms of business, I believe they are covered as well in a lot of other modules. So we do have three major forms. Um, so proprietor, partnership, and corporation, and there are some differences here, right? So let's look at what are they. So in a sole proprietor, to understand what it means, is basically just a one business owned by one person, right? So the person is owns this business. We do have some advantages, disadvantages. You can look at them. Mostly is that it's very easy to set up. It is simple. You are just one owner. It's like your things like your mama shop, right? Your mama shop is like mostly a sole proprietor. Maybe some small, below your blocks, hardware store. Usually those are sole proprietor as well. Okay. For partnerships, this is where it is a business owned by two person. So partnerships are quite common in terms of things like your law firms, your accounting firms. Most of those are partnerships. So the partners basically own the business, and it can be like 5 partners. It can go all the way to like 10 partners, right? So these kind of firms usually are under the partnership, and they share so-called the revenue of the partnership. There are some advantages and disadvantages. Even in Singapore, there are things like a general partnership or limited liability partnership, LLP. So again, these are the reason why it's not in detail here is usually you just can't really understand. You don't really need to know all the small details because usually never tested. So again, going back, so there are general partnership and limited liability partnership. So of a general partnership, there is unlimited liability, right? So meaning, anyone know what it means? Liability, unlimited liability and limited liability. Oh, that's a good question. Okay, look at that. Okay, so I'll go for the question first. So yes, what if it passed down next generation? So for a sole proprietor, technically you cannot really pass it down to the next generation, right? So when the owner or the sole proprietor pass away, he or she will have to so-called close the sole proprietorship, and then maybe pass the money that he has gotten or she has gotten from the closure to the son and daughter, right? Nowadays, there are some clauses which allow some kind of transfer, but in a more traditional sense, usually there is no way to transfer to the next generation, which is why sole proprietor is a bit tricky. And nowadays people try to go towards more partnership or companies, right? And in Singapore, of course, we know that setting up a private limited company is not super difficult, right? It's quite easy if you just need to make sure that you have the accounts done. Like that's why some of you all might be accounting major, or um, and you need to make sure that you have like a corporate secretary and stuff. So it's not so difficult. So most people nowadays set up a private limited instead of a sole proprietor for the reasons that it's hard to pass down to the next generation. Okay, so unlimited is how much you need to pay for that. Yes. Okay. I think like debt incurred. So most of y'all are getting it at is about debt. It's about collateral. Yes, in some way collateral. So the yeah. Okay. So I think the last answer, that's like totally right. So okay, so what is the difference? Basically, the idea is that if it's a limited liability partnership versus a general partnership, so a limited liability partnership means that the partnership is okay, so all the partners in the partnership are limited to the debt incurred, right? Limited to the debt incurred by the partnership, right? Meaning that what if let's say the partnership goes bankrupt. However, the partnership only has, let's say, 1 million, but the debt is 10 million. So the additional 9 million of debt cannot, the let's say the bank cannot go towards the partners to claim the 9 million that the partnership doesn't have, right? So that's limited. So the debt incurred is limited to the partnership. However, if it's a general partnership, what happens is that if the partnership only has 1 million, the debt is 10 million, right? So the bank needs to claim 9 million, right? So the bank can actually go towards the partner and say, oh, okay, each of you all have a house. How about you sell your house? Okay, they don't ask you so nicely, but they will basically take control of your house and sell it to repay the 9 million that is owned by the partnership to the bank. Okay, so it is related to what all of you have been saying. There's this view, corporate view in case of liability protects the partner. So most of the time nowadays, they are all limited liability partner because it's not so difficult to set up compared to a general partnership. Oh, so ownership is also slightly a bit more difficult to transfer. Of course, this is all relative, right? Compared to private limited company or a corporation. Now, in our case, most of the time, when we talk about company, when we talk about all the topics that we are discussing, we are always referring to a corporation here, right? So we take the stand of, okay, we are trying to do like capital budgeting for a corporation, or let's say we are trying to do a capital structure for a corporation, right? So we always take the stand of more of helping a corporation to do it, and your corporation is your typical can be a listed company or can be a private company, private limited company, right? So in most sense, I think most of you all probably know like, oh, okay, you can buy shares in a company, right? So when you buy a share in a company that is listed, it means that you are part of a owner of the company. You own a small percentage of the company, whether you can influence the decisions, whether you can say, oh, I don't want this manager, depends on how much you own, right? So in a listed company, usually the ownership is quite fragmented, we call it, meaning that there's many so-called owners because we can all buy like one share or two share, right? And then you have like 0.1% of the company. So that's how a corporation works. And the important part is that, of course, it's easy to transfer ownership. As we mentioned about, I think a point mentioned that for sole proprietor, it might be hard to pass down to the next generation. So for for corporations, it's quite easy, right? Because you own a share. And let's say you want to transfer this share, you just sell it, and someone buys it, and basically you just transfer the ownership already, right? So it's really easy. Of course, it's easy to raise capital as well because you can just go to the market, you sell some shares, if you can raise more money. Okay. This is the part that I want to focus on. I put a star here because it's an important concept. So the disadvantages of a corporation is this main thing, right? Remember the concept of you buying a share, then you become an owner. So anyone can be an owner, right, of a corporation, which is good. However, it's bad as well. Okay, why is it bad? Because your motivation to own the share of the company might be very different from the motivation of the managers managing the company. Okay, I repeat again. In a corporation, there is this idea of a separation of ownership and management. Why? Because if you buy a share, let's say in Google, your motivation to buy this Google share is very different from the motivation of the manager that's working in Google, right? So this separation is what we call an agency problem. And this is what we'll look at in the next slide. We'll try to explain more. Last but not least, there's double taxation, meaning what? The corporation is taxed at a corporate tax rate of 17% in Singapore. And then at the same time, whatever salary that you earn is being taxed at your income tax level. However, if you do buy shares in Singapore, you know that there are no taxes on capital gains or dividends, so it's not too bad. May I just pause here? What's unlimited life? Thanks for pointing that out. Okay, so for unlimited life means that the corporation will never close down if the person, the so-called the original owner, let's say he passed away, he can just sell the shares to, let's say, his son, right? So because of that, the son can, if he eventually pass away, he can sell it to his son, right? So it can pass on for many generations, and because of that, there is no limit to the life of a corporation. All right. Maybe we talk about a little about this limited liability. So it's the same thing like private limited company. So a private limited company, or PTE Ltd, is an example of a limited liability, right? So it's what we talk about. The bank cannot go after the assets of the shareholders in this case. Okay, may I pause here? Any questions on what we covered so far before we jump to the next part? Okay, I believe not. Okay, so this is just a slide. It's more of just for your understanding that a financial manager is trying to show you where does the financial manager sits, right? So it's generally the CFO position here, and under the CFO position, you have various functions, right? Functions of finance. Not so important. I'll just move on. Okay, so when we talk about, remember, I say when we talk about a any like company in this course, we are always referring to a corporation, right? So think about it as like a listed company. So what is the goal of a corporation here, right? So what is the goal? Is it to maximize profit, minimize costs? Oh, what's happening? Okay, you have your slides, right? So you can see. Oh, strange. Let's see. Okay, as it minimize cost, maximize market share, or be number one in the market. So I want to highlight at this point, what does maximizing market share means? Anyone knows? Like, what does this mean? Maximizing market share. That's good. That's good. I see. Yeah, right. Yeah, absolutely right. So it's the proportion of the customer base, right? Maximizing like Alibaba for e-commerce. Perfect. Sorry, I think somebody. Yeah. Okay, so we have a comment on profit related to since. Okay, so it depends on, I think, the initial answer, proportion of market base, maximizing the number of customers, what percentage of, let's say, Alibaba has or e-commerce in maybe China. So the percentage is market share. So you're right. Now, it means that, imagine a pie, right? I like to use this very easy example of a supermarket, right? So, supermarket in Singapore, we have your Fair Price, Cold Storage, and then you have your Sheng Siong, etc. But we know that kind of like Fair Price. So this amount here, Fair Price, this is probably Fair Price, because they have the biggest market share in Singapore supermarket. And then this portion is your others, right? Your others include like your Cold Storage, Sheng Siong, maybe Giants, but they're all very small players, right? So maximizing a market share means that you want to expand the pie and have more and more of the pie, right? So that is market share. Now, this is very different from maximizing the current value per share. So maximizing current value per share is really based on the market. So you look at the stock price. So you want to make sure that stock price is the highest, right? You maximize the current value of the share. So what should be the goal of a corporation now? Is it maximizing market share or maximizing current value per share? Yeah. Okay, we have market share, value per share. Okay, so I want to highlight that it should be value per share. So it's different. So this is the right answer. Maximizing the current value per share is the goal of the corporation, and not market share, right? Market share is like we talk about, oh, I want to be number one in the market. I want to have the largest pie, this largest pie that we see here, the largest pie, right? However, the goal at the end of a corporation is to maximize the value per share. And the reason why, okay, I think it's important to understand why. The reason why is that at the end of the day, who owns the corporation? Remember, it is you and me, right? If I am a shareholder, yes, correct. So if I buy a Google share, one Google share, I basically own one 0.01, let's say, of Google, right? Like if I buy one share, which means that what am I interested in as a shareholder or buy or holding Google share is that I'm actually interested in making sure that share price is as high as possible, right? Then I get some gains if I sell the share, etc. And because of that, it is the goal of the corporation is to actually help the shareholders, which are the owners of the company, maximize their value, meaning to maximize the share price, right? Value per share. So maximize the share price for them. So that is the goal of the corporation. Okay. So this is important. You can see why I went into detail. So you need to understand what is the goal and what's the difference between market share and value per share. So of course, when we see this, right, maximizing profit, minimizing cost, this is more on the traditional sense, right? If you maximize profit, you reduce costs, your share price might increase. I say might. But as you know, nowadays there are a lot of other factors, right? There are like things like ESG that's become important, or not only that, but maybe even the like a new product, right? If you introduce a new product, if the market likes it, your share price might increase, right? So it's not really just purely maximizing profit, minimizing cost. It's a lot of factors, right? So this is not the goal of the corporation. Yes, it can help to increase your share price. However, there's so many other factors, right? So, you need to think about things like ESG, think about marketing a new product or maybe going into a new segment, and this will also boost your market share. Sorry, not market. You boost your share price. Any questions on this? And if you do have any doubts, feel free to put in a group chat, or need me to repeat certain parts as well. Just feel free. Okay. Okay. So the goal of financial management now. The question is, should we help the owners maximize everything? Cut costs, offshoring, outsourcing. So like what we talked about earlier, the answer is no, right? Because we need to consider a lot of other factors nowadays. We can't just think about, oh, you want to maximize profit, minimize cost. We need to think about, that you have things like CSR, right? People say, oh, CSR can help boost the share price of the company, right? So things like CSR, charity, and all must be considered. So it's not just maximizing the wealth. Okay, so we go back to the concept that we talked about remember we mentioned agency problem, where is the shareholders and the managers are kind of like separated, right? The shareholders wants to maximize their share price. Maybe the managers don't want. And I'd like to bring this idea that maybe some of your have already started working, right? So you're taking this as a part-time course. And so some of you might even be managers in companies, right? So you know that working in a company, your goal is not to help to maximize the okay, if it's a listed company, not help to maximize the share price for the shareholders, right? Or maybe if it's a private limited company, your goal, if you're working in a private limited company, your goal is not really to help the owners get as rich as possible, right? That is not your goal. Most of the time, for if you work in whether it's a company, a private limited company, a listed company, maybe your goal is to, I want to get a bonus, I want to get a promotion, right? So those might be your goals compared to the owners, right? The owners of course they might not want to pay you so much, so they don't give you a promotion, right? So you can see the goals are very different already. And this is this example that I explained is the idea of an agency problem. So you working in a private limited company or listed company, you are an agent. Yeah, great. So agent meaning what's an agent? So agent is anyone, just any person, right? An agent, if you're a CIA agent, etc. But you're just like a manager, like an agent, right? So the problem with the agent or the agency problem is that you want to get a bonus, you want to get higher pay. However, the owners, shareholders or owners of the company might not want to give you that, right? So this is a agency problem really. And because your motivation is different, maybe if you, let's say you didn't get a promotion, then you decide, okay, I don't want to work anymore, or not doing work, but you want to slack, right? You don't want to work so hard. You don't want to, you stop doing OT, or maybe you just work the minimum, you just submit whatever, and you don't really care so much, right? So your motivation might be lesser than what the company wants you to be. And this difference in motivation, difference in interest is the idea that is very, I would say, unique to corporation simply because the shareholders and the managers they hire to manage the company are different people. So the principal, it means the shareholder, right? The shareholder hires an agent, which is like the manager. The manager will represent their interests. However, because of the different interests between the principal, which is the shareholder, and the manager, it gives rise to agency problem. The conflict of interest between principal and agent. And this conflict of interest will cause agency cost. So what does agency cost mean? It means that maybe the company might lose some money. They might lose a good deal because the manager decide to work less. He's not happy with the he did not get a promotion, so he will decide to work less, right? So this will, and because he worked less, the company lost a deal, and this will be a cost to the company. So this agency problem. So before we move on, everyone understand this concept of agency problem? Any questions before we move on how to tackle it? Because this is a very important concept that we need to know. Yeah. Okay. Let's see. What's up? Which is good. Okay. So I guess no issues. Now, how do we tackle this, right? So we do have some remedies to try to tackle agency problem. And the main one that most of us probably already know is this idea of managerial compensation. Basically, the idea is to try to align the goals of the agent and the goals of the corporation, right? So a typical example is stock options, because if the manager owns some stocks, then maybe the manager will feel like, oh, I need to also increase the value of my stocks, right? So when the managers wants to increase the value of stocks, this is kind of aligned to the goal of the corporation, right? which is to increase the value per share, right? So you kind of like make it similar. Of course, there are some incentive as well where, if you are a manager and you know you you have exhibited some, I don't know, strategic management way that will help to boost the stock price, then other companies might be interested to bring you over because you can help to boost their share price value as well. So increase the attractiveness of the manager. So incentive needs to be carefully structured. Now, another thing that might try to align the goals of the manager and the corporation is corporate control. So what does this mean? It means that, you know, because the shareholder would elect a board of director, so they elect a board of director who will manage the company, right? So if you are a manager and of course if you don't work hard and the board of director decides to fire you, this threat of being fired will kind of force the manager to work hard, right? Everyone can understand that. The threat of being fired would force you to work harder and therefore try to align the goals of you because you don't want to work hard, but now you're forced to work hard, so you work hard to the goals of the corporation. So, of course, the threat of being fired is not the only threat. It can be also the threat, external threat. So, what does external threat mean? It means the threat of being taken over by um, another company, right? Let's say if it's a listed company, maybe what happens is that some other shareholder tries to buy out all the shares, right, and become the majority shareholder. And once this person or this other entity becomes a majority shareholder of the company, he or she can make or can pass any kind of decisions, right? And this threat um, of the shareholder become majority shareholder, usually what happens is that the majority shareholder would tend, okay, so not 100%, but most of the time, they tend to fire away or fire the management team and bring in a new management team, right? A very typical example, I think if any of y'all like are in the social media space or reading the news, you know the idea of Twitter, right? What happens when Elon Musk came in and took over or became the majority shareholder? He didn't get he didn't own 100% of Twitter. He's a majority shareholder of Twitter. And after he did that, he actually revamped the whole team, right? He changed the whole team. He fired a lot of the CEO, CFO, etc. And this action of, or this threat of being taken over by one particular shareholder can kind of force managers to work harder to prevent this from happening, to prevent a takeover from happening. So this is how there's a bit of more alignment between the manager and the existing current shareholder. Any questions so far about this corporate control? Okay. Okay. So the next part. So I think I forgot to mention this. You'll find a set of slides that are in our tutorial group. And so these sets of slides in tutorial group, basically I've just do some reshuffling and maybe sometimes even added some more explanation slides. So I encourage you to use that, even though there are slides posted on the main group as well, right? The L01 group. So in case you are still using the L01 group, L01 group slides, encourage you to pick up the slides in our tutorial group instead. So at the end of most of a lecture, we have these self-review questions. Usually, I will not really go through them. You can just look through the self-review Usually if you need the answers, feel free to reach out to me. But most of the time, it's just more like general questions to just test your understanding, right? So you can have a look at them. All right, now let's move on. So we have talked quite a bit on like the company. We talk about the general structure. So that's more of an introduction. Now let's move on to something more, related to numbers and finances. And so first of all, let's understand a financial statement. Have everyone taken the basic accounting course here? The accounting 101 course? Okay, no. Okay. Oh, okay. Oh no. Okay. That's surprising. Okay. So most of y'all not really taken it. Okay, so can I assume that this is probably the first time you're looking at a financial statement, or have you seen a financial statement before? Yeah, ACC, yeah, correct. 202. Yes. Secondary school. Okay, secondary school. Okay. Okay, so I guess most of you have seen it maybe in secondary school. All right. So let's try to understand. I'll try to explain again the financial statement, right? As like a refresher for you, in case you forgotten. Since secondary school might be a while back. Okay. So financial statement. First, we look at the balance sheet, right? So a balance sheet basically shows the firm's asset and liability, right? So you have asset and liability here. Uh, of course, there's owner's equity as well, but mainly is not mainly, but let's look at asset and liability first. So asset is usually on the left side. Okay, nowadays not really, but we'll see an example in a bit. But in a traditional sense, usually asset is the left side. All right, liability and owner's equity is on the right side, right? So basically, it becomes like this: asset, liability, and OE on the right side. So it balances, right? It's like a balance. Now, how do you remember this? I usually like to remember it as ALOE, ALOE, like the plant, they use ALOE. So what does this mean? It means asset equals to liability plus owner's equity. So it forms ALOE. That's how I remember, in case you kind of don't know how to remember what equals to what, right? So asset equals to liability plus owner's equity. Uh, there's this small comment here that balance sheet is as of, meaning at one point of time, right? So it means if it's tomorrow, so you did a balance sheet today, which is 22nd January, right? If you want to do a balance sheet on 23rd January, the numbers might be different. Okay, so it's as of one point. Okay, so this is the example of a what does this mean? So it balances, meaning what? The total value of the asset equals to the total value of liability plus owner's equity. So in assets, you have your fixed asset, which is your long-term asset that we talk about, like PPE, property, plant, and equipment. You have things like intangible and tangible, meaning that you can have things like brand name. Brand name is an intangible, right? Tangible includes your PPE, like what we talked about. You have your current, so fixed and current, right? Current is things like, oh, maybe cash, right? Cash is current, or accounts receivable, AR, right? So these are current assets. So this total value of asset here must balance here, right? And here, what do we have? Owner's equity. So owner's equity, what does this mean? It means that money that the owner of the business put into the business, right? So this is the equity to them. So this is the owner's equity. We do have some debt. So debt, we have long-term debt, and we have current debt, right? Yeah, see that question? Yeah, I'll repeat. Let's complete this first. So for long-term debt, it is more of like, oh, take a loan, long-term loan. Let's say you have a mortgage loan of 20 years, so it's a long-term debt. Okay, like a loan. A current debt, current liability. So current liability can be things like accounts payable. Accounts payable. This is relates to the amount that you owe your supplier, right? For example, you buy. This relates to supplier. For example, you buy raw material, right? And you don't pay your supplier yet. You take the raw material, you owe your supplier, right? So that's account payable. So these are your current liability, account payable. Okay, can you repeat? Okay, for sure, yeah. So the difference between tangible and intangible. So intangible, let's talk about intangible first. Intangible includes things like brand, brand name, or we have these things called patents as well. Patents, which relates to like intellectual property, right? These are intangible, right? You can even put, so brand name includes things like reputation, right? So like things, for example, if you imagine Apple, so Apple has a very big brand name, right? They have very big, if you look at their balance sheet, you will see actually a lot of intangibles because the name Apple, it's just synonymous, right? Everyone knows what is iPhone, what is a MacBook. So this is an intangible, this brand name. Now, a tangible is everything else. And what does everything else mean? In a fixed asset sense, it means things like, let me just write here, like MV, right? Motor vehicles, or things like PPE, plant equipment, or even like buildings, right? Buildings. So building your factory, all these are tangible fixed assets. Hope that's thanks for the question. That's good. All right. Oh, one more part before I don't want to. So what is this net working capital? So this is a very important concept here. Let me put a star here. So what is net working capital? Remember we mentioned earlier about working capital, and I mentioned, okay, working capital is this thing where is the capital used for daily operation of a business, right? So how do you calculate working capital or net working capital? Is CA, current assets, minus current liabilities, CL. Okay, so I repeat, the net working capital is current assets, CA, minus CL, current liabilities. And we will have another slide, to explain this in the next few slides. So do not worry. So our so working capital, so this kind of explanation here, net working capital, net working capital is the capital used for daily running of business operations, current asset minus current liability. Generally, a positive working capital is a healthy business. Okay, let's try to understand this. A positive means that there's more CA, less CL, right? Current liabilities. So it makes sense, right? That means that you have more assets and less short-term liabilities or current liabilities, right? So you make sure there's enough assets to cover the liabilities. So in a more general sense, yes, it represents a positive and a healthy business. Liquidity. So what is liquidity? So liquidity is how easy is it to convert certain things into cash without losing the value, right? So a highly liquid asset is cash, very liquid. Now, an asset that is not very liquid can include buildings, right? Let's say you own the office building. However, it's very hard to sell the office building, right? You need to put it in the market. You get a valuator to value the office building. Maybe you need to do some repairs. So these are quite tough. So it's very illiquid. So the speed and ease of conversion of asset to cash without, the important thing is without losing significant value. All right, debt versus equity. So what does this mean? It means what? Let's say you buy a car, right? You buy a car. You know that when you buy a car or even buy a motorbike, what happens? You are supposed to pay certain proportion in cash, right? You need to have some cash. So you pay that portion in cash. So that amount that you pay in cash is considered your equity, right? You're putting equity inside. Now, there will be a portion that you want to take a bank loan to pay your car or motorbike, right? So that portion is your debt, right? So if you buy a car for your company, imagine you own a private limited company, you need a car to drive around to meet your clients, right? So yes, you buy this car under the company name, but you do not want to pay 100% in cash, right? So let's say you use your own money, you pay 50, let's say the car costs 100,000, let's say it's 100,000. So 50,000 you pay in your own cash and means that you're putting equity in the business. So that's equity. Now, the other 50,000, you're going to get a bank loan, and that means it is a liability, right? So liability and owner's equity. So there's a difference. Okay, so this is a example of a balance sheet that you'll see. Can you see that it's like balance? This is your asset, liability, and owner's equity. You have your various items here, line items, your fixed asset, your current asset, current liabilities, long-term liabilities. And last but not least, your owner's equity here. OE, these are your liabilities. This here is your assets A. Okay. At this point, maybe I'll just highlight that nowadays, most companies do not present their balance sheet like this, like a T, asset here, liability, owner's equity, like this. Most of them present it in one whole line, meaning what? Asset, there's no account at all. There's no account like this. It's just asset, liability, owner equity. So it's all in one line, right? So you don't really see the balancing nowadays, like more traditional kind of way they present the balance sheet. Some companies still do that, but not many. Okay, so no, before we go into market and book value, let's take this time to have a break. Let's come back and let's say 7:08. Or sorry, 8:08. Because it's 1 hour after. So let's come back 8:08, meaning it's called like a 7 minutes break. And then we'll come back to move on to the next part of the lecture. In the meantime, during your break, feel free to drop me a email if you have already formed your GBA groups. If not, use the time, you can just reach out to anyone, see whether they want to join a group together with you. All right, let's do that. We'll come back in around 7 minutes. All right, welcome back. I think I saw someone just emailed me on groups. Thank you. Um, okay, let's continue. Okay, so just before the break, we were just talking about balance sheet. We were talking about things like asset, fixed asset, right? Now, for most fixed asset, we have this idea of what is the book value versus market value. And like how I like to understand it is, okay, a book value, imagine you buy a building, right? Now, the cost you buy the building, that is your book value. Okay. However, after the build, after 5 or 6 years, or even 10 years, the building price might increase dramatically, right? Let's say you bought a building in CBD. After that, increase by 50 or even 100%, increase a lot. Now, the increase in price, that new price is the market value. Okay? So that's the difference. Now, book value basically in a more official sense, in terms of definition, is the balance sheet value of the asset. Can be liabilities and equity as well, right? But let's just focus on the asset. And so book value equals to cost of the fixed asset minus the accumulated depreciation, right? So even for a building, you need to depreciate the building. And so there will be kind of depreciation that would accumulate. And you need to minus that every year. Is because I know some of you have not taken the accounting module. Does anyone or is everyone familiar with this concept of depreciation, or do you think, or do you need me to do a recap of what is depreciation? Recap? Okay, okay, we have it. Okay, let's do a recap then. So depreciation. So what's depreciation? So depreciation is only relating to fixed asset. And the idea of depreciation is this, right? Let's say your fixed asset costs $100. Okay. It might be, let's say, a computer. Okay, nowadays computer don't cost. Let's say 1,000. Okay, your computer costs $1,000. Now, maybe this computer you can use it for 10 years, right? Before it spoils. So what depreciation means that you have to allocate $100, so $100 per year for 10 years, right? So 100, 100, 100 for 10 times equals to the cost of fixed asset of 1,000. So the basic idea is that, okay, you just want to allocate the cost to number of years that you can use the computer, right? So this is depreciation. Now, accumulated depreciation means that, okay, for this computer in year 4, what is the accumulated depreciation? It is 400. Everyone understand? Because after 4 years, year 4, 400. So this 400 is the accumulated depreciation. And the cost of the fixed asset is your 1,000. All right. So moving on for market value, um, the idea is that it is the true price of the fixed asset, liabilities or equity, right? But mostly we focus on fixed asset. So, like I mentioned, is the actual price of the fixed asset. Let's say if you have a building, you value the building after 10 years, the price usually, especially in Singapore, will increase like crazy, right? So that is the actual market value. Um, the reason why market value and book value is very different, as you can already notice in the example of a building, the building, you have to depreciate the building, right? So you keep on reducing the book value of the building. However, we know that most of the time, building prices increase over the number of years, right? And because one, the book value is causing the building to reduce in value, but the market value is causing the building to increase in value. This increase and decrease would result in a very different pricing of the building. Okay, they have a question here. Which is more important for decision making? Market value or book value? Anyone wants to try to make a guess? And both market value. Okay, we have more market value. Okay, so those that say market value actually are right. Both okay, both is also kind of right. Why? Okay, let's try to understand this. Most of the time, if we can get the market value, we want the market value because that is the best. However, later as you progress on in this course, you'll notice that most of the almost 80% of the time, I would say, we always use the book value because market value can be very hard to obtain. So we no choice to fall back on the book value. But if you want the best, so-called the best number, is actually the market value. Okay. So market value is the best. So this example here, book value, market value, book value, market value. So income statement. So just now we talked about balance sheet. Now we talk about income statement. So income statement is like your P&L statement, right? So with P&L statement where you at the end of the day you just want to see what's your net profit, and then you have your revenue, gross profit, expenses, and net profit, right? So that is your P&L or income statement, profit and loss. In case you know what's P&L. Profit and loss statement. So when we say about bottom line, so bottom line is your net income, right? Sometimes we'll refer things like what's the bottom line, it's net income. We have this thing called the top line. So top line is your revenue. Top line is revenue. So your bottom line, right? Your net income will be divided into two parts, right? Once you have your net income, your bottom line, a portion would be retained in the business, called retained earnings, means you do not distribute to your shareholder. And the other portion you distribute to shareholder in terms of dividends, right? So your bottom line is split into two. A portion is distributed to shareholder, the other part is retained in the business. Okay, we do have a question here. Can book value be like a safety net, for example? Let me think. It depends because the iPhone example you give is kind of correct. However, we need to know that like certain assets could reduce in price in terms of market value. So think about it. So sometimes, right, in the property market, while most of the time in, let's say in Singapore, property always rise, right? The property prices always rise. So book value can kind of be like a safety net in the example. However, yes, market value can go even lower. So in certain markets, like if you look at the Malaysian market for properties, most of the time, not most of the time, okay, I would say 50% of the time, the prices of that property will actually go below the selling price, right? Due to various reasons, maybe it's political reasons, it could be maybe location, etc., right? And when it goes below the book value, that's where actually your book value doesn't become a safety net anymore. So yeah, you can say it's a safety net only if you know that market value is always going up higher than the book value. Then it's kind of like a safety net. Okay, so this is your income statement. I believe most of you should be familiar with income statement, right? It's like your P&L, your profit, to show your profit, loss, expenses. Okay, financial statement, we have a few concepts. Okay, so these are more like very accounting concepts, but they are important to know, right? So those that have taken your account, your 202, ACC 202, you might already have gone through this. Those that haven't, can learn it here, and then when you take your 202, you can realize it's kind of similar. So we have this idea called the matching principle. So what does matching principle means? So it's explained here, but I'll try to make it like in more of like layman terms, more easy to understand terms, right? So what does this matching principle mean? It means that the revenue that you earn, so R revenue, must be matched to the E, which is the expenses, right? That relates to the generation of the revenue. Okay, so one example to think about it that we have already discussed earlier is the idea of depreciation. Remember the computer of $1,000, and then we say we can use for 10 years, and then we distribute the expenses for 10 years. So you know the computer is being used to, let's say, reply emails, used to do Excel sheet, etc., which is relating the generation of the generation of revenue of the business, right? So can you see the reason why we apportion the cost of the computer, the book value of the computer to 10 years is actually relating to this concept of matching principle, because we know that the computer will last for 10 years, and we know that this computer would generate revenue for us for 10 years. That's why we divide it by 10, right? So that's how we see it. For example, if you realize that, hey, you know what? Actually, after 5 years of computer, you have to change the computer. It doesn't work, or it doesn't function so well already. Now, if this happens, then you have to divide the cost of the computer by 5 instead of 10, because now you must relate to the revenue generation capacity of the computer. So this is the matching principle. Another concept is non-cash, which is just now why I use the computer example, because the computer example is talking about depreciation, right? And we know that depreciation is non-cash. What does this mean? It means that, does this mean every year, okay, let's use the computer example, $1,000 for 10 years. Does this mean every year you have to pay $100 of depreciation, like pay? No, right? You don't pay like expense, like you don't put the cash out, right? It's like a counting concept. Yeah, that's right. It is kind of like you just need to deduct the $100 in your balance sheet and your income statement as well. You need to recognize it at both sides. So this is a non-cash item, and in finance, usually we have to add it back. Add it back meaning what? Because in your income statement, you have to less depreciation expense, right? Less meaning minus depreciation expense. Now, in finance, because we are interested in cash moving in and out, okay? We're interested in cash flow moving in and out of the company. So usually for non-cash item, we have added back. So depreciation is usually added back. Later we have a look at this addition. Accrual basis of accounting. So accrual basis of accounting means what? You record the revenue when earned and not when cash is received. So what does this mean? So accrual basis result in this thing called, oh, this thing is happening again. Oops, not sure what's happening. Okay, so accrual basis of accounting, record revenue when it's earned. So you have this thing called the unearned revenue. Okay, so unearned revenue, unearned. So these are accounting. Hopefully, those that have taken accounting 101 or your ACC 202, you kind of know already. But I'm just going to repeat this a little. So record revenue is earned. So let's say your customer comes to you and say, you know what, can you help me, let's say, repair this iPhone, right? You have iPhone and you are a repair store. Your customer comes like, oh, can you help me repair the iPhone? He's like, okay, can. However, you must pay first, right? So you ask the customer to pay $100. Now, on as a company, right, have you actually earned this revenue? Have you actually repaired the iPhone for your customer? No, right? You have not repaired the iPhone yet. And so this is your unearned revenue. And so can you record this? No, you cannot record it as revenue. You record it as unearned revenue. Unearned revenue. And unearned revenue is considered a liability to you because you have not performed the service for your customer for the iPhone. So it means that record revenue when it's earned and not when the cash is received. So even though you receive the $100, you cannot record it as revenue. The next part of accrual basis accounting means that record expense when it's incurred and not when cash is paid. So what does this mean? Accrued liabilities, that's right. It means accrued liabilities. Accrued liabilities, what does this equate to? For example, let's give an example. You know your utilities bill, right? Your utilities meaning your electricity, water. These bills are usually paid for the month ahead, right? Let's say you pay for the month ahead. So have you consumed the utilities? No, right? Good example is salary as well. Yes, salary. Have your staff actually worked for that month? No, right? Most of the time, salary you pay in the middle of the month, but it means that 50% of the month has not the work, your staff has not worked yet, right? Because you're paying only in the middle of the month. So that 50% that has not worked is your accrued expenses. Yeah, like bills. Yeah, pay for November, but bill can be paid for December. Yes. So why is this concept important? Because in accounting, we do all this kind of, we have this kind of concepts like accrual basis of accounting, non-cash. And the thing about finance, because remember, now we are learning finance, right? Finance is very different. Finance, we actually focus on the cash flow. We want to see whether the company is generating cash, you know. So because of accrual basis accounting, sometimes the company might be profitable. However, they might not have cash because of accrual basis accounting. And they might go bankrupt because of that. In the most simple example, imagine you have, let's say, a lot of accrued expense, right? You have to pay, you pay that your expenses. However, let's say for your revenue, you have not received the revenue yet. Your customer owe you a lot of revenue, right? They owe you a lot of revenue. And because of that, because your customer have not given you the money for the service you paid, they owe you money. However, you have been paying a lot of the expenses in advance. This might result in a bankruptcy situation. You have not enough cash in the company. Okay, so the concept of cash flow is very important, most important concept in what we are learning throughout this whole entire module. I want to caution you about this, that the cash flow we are talking about does not equals to the cash flow statement numbers, right? So those that have taken the 202 will know that there is this cash flow statement. So we have three statements, right? Balance sheet, income statement, and cash flow statement. And we know that the cash flow statement has some like cash flow and stuff, but whatever we're talking about now is not equals to cash flow statement numbers. It is finance cash flow. The reason why is because finance, we are looking at how cash is generated by utilizing certain assets and how do we pay to finance this asset. So we're looking at a certain asset, how this asset generate cash flow, and how do we pay for this asset. So that's what we're interested in finance. Okay. Now, this is an example of, not really example, but this is the key concept in this module on cash flows, right? So at this point, I want to put three stars here, I hope you can put this on your slide as well if you're following me, is that this is very important to understand every single component of this formula calculation and what it means. So, do not hesitate to stop me or if you need me to repeat, because this is a very important concept. And the thing is, we'll use this in this lecture 1. We'll reapproach this in lecture 3 and lecture 4. We'll keep on coming back to these few concepts. Okay, so what does this mean? Cash flow from assets, CFFA, right? So what's the cash flow from the assets? Remember earlier we talked about finance. You're interested in how cash is generated by utilizing assets. How do we finance the assets? Okay, so cash flow from assets, CFFA, comprised of 3 components: operating cash flow, net capital spent, and change in net working capital. Okay, so let's focus purely on, okay, let's do the last two first, okay? Last two is a bit easier. Okay, so let's look at this, net capital spent. So let's think about the overview first before we go into the details, right? So how much cash is being generated by the asset is being determined by, okay, the cash that's being actually generated, right, which is your operating cash flow. What's the actual cash, the positive cash flow generated, minus away whatever you spend, right, to buy the asset. So this is your net capital spend, whatever you pay to buy the asset, minus away any capital expenditure, not capital expenditure, sorry, working capital that needs to be used in order to generate your operating cash flow, right? Remember your net working capital. Remember, working capital is what is it? If you flip back to your initial slide, it is the capital required for daily operations of business. So whatever capital is required for daily operations must be less of, right, from your operating cash flow. So that's why there are 3 components here. Everyone understand this? Why there are 3 components? Do you need me to repeat, or we are good? We can continue. Do I have to be shy if you need to repeat? Okay, can repeat. Okay, so let's repeat again. So cash flow from asset, CFFA, right? It is the cash, the net cash. Net cash meaning after all the expenses, movement, right? What is the cash that your what's the cash that your assets is generating, right? What is the cash that your asset is generating? And it's made out of what? It's made out of, number 1, operating cash flow. So operating cash flow is the cash that's being generated in your operation of business. What does operation of business mean? It means that you sell a product, right? You get positive cash, right? Of course, the more product you sell, the more cash you get, right? So that's operating cash flow. You positive cash. So it gives you positive cash inflow to you. Now, you less of your net capital spend. So what's net capital spend? Net capital spend is your negative cash flow, your cash outflow, basically it means a cash outflow to buy assets used in the generation of your operating cash flow. What are some examples? Negative cash, for example, buildings, right? You buy a building. Or things like motor vehicle, you buy a motor vehicle. So these fixed assets you bought these fixed assets, resulting in cash outflow, negative cash, but it's being used in the generation of your operating cash flow. Now, last but not least, is your negative, again, let me just erase this. Again, is your negative cash flow from your working capital, right? Remember and recall, what is working capital? Working capital is your capital used for daily running of your business. Okay, so what is the cash required for daily running of the business? For example, petrol, things like stationaries. So these are required for your day-to-day running of business, and these are part of your working capital. So you need to, it is a cash outflow as well, because you pay for petrol, pay for stationaries. These are negative outflow, right, coming out. So in aggregate, in total here, your CFFA equals to your operating cash flow, which is positive, minus away your net capital spend, which is negative, right? Because you minus away the cash outflow, and minus another cash outflow of change in net working capital. Okay, I'm a bit confused. Does that mean net capital spend is referring to, okay, yes, net capital spend refers to fixed asset. Uh, it does not relate, and it's not fixed asset minus capital expenditure. Okay, it's just actually capital. Okay, so yes, okay, you can think of it as okay, yes. So it refers to, okay, yeah, that's right. So net capital spend is referring to fixed asset. Yes, it's very fixed asset, and it's relating to capital expenditure. That's correct. Because is, remember, capital expenditure is how much you spend on fixed asset products, fixed asset items, right? And so relating to this point, how do we determine net capital spend? We know what's the ending fixed asset, right? Ending, for example, at the end of the year, what's the amount of fixed asset? Minus away your beginning fixed asset. So how much do you have before the start, or not before, but at the start of the year, right? Now, if you minus both of it, ending minus beginning, you get the how much you have bought, how much capital expenditure, or how much fixed asset you have bought, which relates to a negative cash flow, right? Because you buy fixed asset, negative cash flow. However, you add back depreciation. Why? Because remember, depreciation is a non-cash accounting item. Does it relate to any cash flow happening? No, right? Depreciation has no cash flow. So you add it back because in your accounting, you have removed it. You have less depreciation expense. But now you must add back your depreciation. Okay. And let me just erase this a bit because it's a bit messy. Okay. Now moving on to change in net working capital. It means that you are right, it refers to working capital management. And what does change in net working capital means? Okay, so first, what is working capital? Remember, net working capital is CA minus CL, right? Current asset minus current liability. That's net working capital. Now, we want the change, this triangle, and this is very important. You want change, the triangle. And how do you get the triangle? You need to get ending net working capital minus beginning net working capital. This is very important. So it's a in your TMA or even in the finals, this is a very common mistake where you forget to do change. Change meaning ending minus beginning net working capital. Because remember, this concept will be in lecture 1 and also again covered in lecture 4 and 5. So usually it's been tested twice, right? So I want to highlight again, you need to calculate change in net working capital. And change meaning ending net working capital minus beginning net working capital. And what is net working capital? It means CA minus CL. Okay, CA is current asset minus current liability. So positive, so if it's a positive change, so now we're talking about change already. So if it's a positive change, means what? There is more and more net working capital required, right? And when you require more working capital means your business is growing bigger and bigger, right? That's why you need more working capital expenditure for the daily operations of the business. I hope everyone can see that. As your business get bigger and bigger, you need more and more and more. So it's positive change in net working capital is very good. However, also it could, so you need to analyze it carefully. It could be due to build up of inventories as well. Because remember, your CA for working capital is CA minus CL, but CA, current asset, includes inventory. And if you have a lot of inventory, this will result in a very positive change in net working capital, right? So it might not be good. When you have too much inventory, you get to obsolescence, inventory obsolescence, meaning that it becomes outdated, you can't sell it, and so it's not good. So you need to be very careful. But in general sense, if the change is positive, it's a good thing. Okay. So now the last component, operating cash flow. So how do you calculate operating cash flow? So it's the cash flow required for daily operations. Okay. So in the most basic form, let's try to understand this. Operating cash flow equals to net income, NI, net income, plus depreciation. Okay, so you can't understand why plus depreciation, right? Because remember, depreciation in accounting is always less depreciation expense, but recall, because it's a non-cash, in finance, we need to add it back. So we add depreciation expense. Okay, we're adding depreciation expense. Now, we need to add interest as well. Interest times 1 minus tax. So why is this highlighted in blue? Because this is, you must read the question carefully, whether interest is given in the question. Because usually this kind is being tested in like kind of a short question, then ask you to calculate. So if interest is given, then you need to do this interest 1 minus tax. If it's not, you just ignore it. Okay, that's why it's in blue. And why do you need add back interest? So let's think about it. Interest is relating to what? How do you get interest? Anyone? How do we get interest? What is interest relating to? Loans, that's right. Debts, loans, right? Now, when we think about daily operations of a business, okay, daily operations, do we usually take loans to operate a business, like for daily operations? And I hope you can appreciate that it's no, we do not usually take loans for daily operations. We take loans for things like motor vehicle, a car mortgage, right? So like more fixed asset kind of investment, you take a loan from the bank to do that, right? And because of this, interest shouldn't be part of our cash flow for daily operations. That's why we add the interest expense back. Can you see? We add back interest expense. This is the reason why. But I want to caution you at this point, it really depends on the question. So you need to read the question carefully, whether interest is given. Sometimes questions just ignore interest at all. There's no comment on interest, means that you just ignore it. You don't care. Okay. All right. So everyone clear on this basic form of operating cash flow? Because the other forms are all derived from the basic form. Okay, and so in the next few slides, I will show you how to derive it. And as you mentioned here, you do not need to know how to prove. It's just for explanation, right? To prove to you that, okay, we have the basic form using net income, then we can actually get all these forms here, right? And why I added this proof, because in the previous sessions that I thought, I don't usually add this proof, but then I always get questions, it's like, oh, how come this depreciation is depreciation expense, how come this depreciation must multiply by tax? And so also must multiply by tax. But why is it like this? Is it something wrong? So that's why I added the proof to show you that actually it is not wrong. You have to actually add it in this way. Okay. So I'll try to go a bit faster for this proof. At the end of the day, I want to highlight you do not need to know how to prove it. It is purely for understanding. If you don't want to understand it, you can just use the formula, right? Because it's not part of your syllabus to kind of know how you derive it. Okay, so how does this work? Now, let's start with net income, NI. So you know net income equals to EBIT. So what's EBIT? Earnings before interest and tax. Okay, so earnings before interest and tax minus interest minus tax will give you net income, right? So earnings before interest and tax, EBIT minus interest minus tax gives you your net income. Now, let's multiply in. So let's multiply it like this. Multiply in. So EBIT times 1 minus tax minus interest times 1 minus tax, right? Like what we're doing here. Now, let's just shift the formula a little. We shift the interest to be like this and EBIT to be like this. Okay, we are just shifting this here. Okay, we're shifting. And then we add depreciation on both sides. So we added depreciation here, we added depreciation here, because we can add anything on both sides of the equation, right? Because they cancel out each other. Now, do you notice that this interest plus depreciation plus interest times 1 minus tax is what we have in the initial formula that we talked about? And because of that, this will be equals to EBIT times 1 minus tax plus depreciation. That's how we get this thing. And then this is just the same, right? This part is the same. So this is your operating cash flow. This is your operating cash flow here, which gives us which formula? This formula here. This one. Now, the next formula to prove is the one on EBITDA. So what's EBITDA? So earnings before interest, tax, depreciation, and amortization. That's EBITDA. So EBIT equals to EBITDA minus depreciation. So I just ignore amortization because we are not going to learn amortization in this module. But if there's amortization, you must minus amortization as well. But let's ignore amortization. So that's minus depreciation. Okay. Then we multiply 1 minus tax on both sides. Yeah, just multiply 1 minus tax. I can do anything on both sides, right? I add depreciation on both sides again. So I can do anything on both sides. Just add depreciation here. Now, on the right side, I do a bit of expansion. I multiply this here and multiply it here. I get this. Can you see? EBITDA minus times 1 minus tax minus depreciation plus depreciation minus tax. So minus depreciation multiply it here, right? Minus depreciation times 1 minus depreciation times minus tax. So you get this. Now I just add back the depreciation here, right? This depreciation I'll just add here. And can you immediately see that depreciation can cancel? And that's why I get EBITDA times 1 minus tax plus depreciation times tax. And then this is equals to operating cash flow. And so basically what we have done is we have proven the second formula here. Okay, I'll move on to the third formula again because this is just more for explanation and it's not part of syllabus, so I'll go a bit faster. So for the third formula, we are trying to get this, even the most basic form. And this formula is, or formulation, we call it tax shield method. So tax shield. And you'll see why in a bit. Tax shield. Okay, so how does this method called tax shield method works? So you know EBITDA, equals to earnings before interest, tax, depreciation, amortization equals to sales minus cost. You multiply 1 minus tax again on both sides. You add depreciation times tax at both sides here, right? Depreciation times tax. Can you see that the formula is very similar to what we have gotten already for EBITDA? Means that this whole chunk here equals to this chunk equals to your operating cash flow. And the question is, why is it called tax shield? Why is it called tax shield? It's because, can you see that you are adding plus depreciation times tax, right? So if your tax increase, your tax rate increase, can you see that you're adding more and more value into your operating cash flow? Right? Can you see you added more and more value inside? If your tax is 5% versus 10%, if you have 10% tax, means that your 10% tax times depreciation, this amount is bigger, right? So you're adding value inside here. So your operating cash flow increase. So your tax actually provides a shield by adding more operating cash flow. Okay. So there's this example here. We are given all this information. Now let's calculate the operating cash flow first. So operating cash flow, we use the EBIT formula. EBIT times, you can flip back to your other slides to see the formula. So EBIT times 1 minus tax plus depreciation. So where's your EBIT? EBIT is here. Your tax rate is given at this. What's your depreciation? Depreciation is this, depreciation expense here. So depreciation is the expense, the depreciation expense. So do not use accumulated depreciation, AD. Do not use accumulated, use the depreciation expense. Ever get this? Again, we can use the tax shield method, the formula here. We get the same answer as well. Then we calculate the net capital spend, ending net FA, fixed asset minus beginning fixed asset plus depreciation. So where's your fixed asset? Here, right? And again, we use depreciation expense. Expense, this is important, it's expense. And remember, we're not done. We need to find the change in net working capital. And remember, change in net working capital is ending net working capital. So where do I get working capital? Working capital is CA minus CL, right? So where's the CA? So ending CA is this one, right? 41403. Where's my CL? CL is this, 389. Okay. And then beginning this and this. Okay. So at this point, I just want to pause for a while. Any accounting person realize any issues with this categorization of using CL for our calculation? Are there any issues using this thing? Any categorization issues? Anyone can spot something? Yes, no, or not sure? So maybe you're not sure because this is very accounting. The thing is, do you realize something? Okay, your CL that we have used here, this one, right? Three, let's say for this, 389 is equals to AP, accounts payable, plus note payable, right? Now, this is okay. So I want to highlight here that in our course, we can accept this method or the other alternative method because both are accepted. So I'm explaining you the other alternative method. Because the other alternative method is actually more correct. However, is you need to really understand accounting. That's why most of the time, like for this course, because it's not accounting course, we are a bit more flexible, right? But if you have taken accounting courses, you know that this is wrong. And what is wrong here? Now, what is note payable? Anyone know what is a note payable? What's note payable? Uh, promissory note, long-term liability. Yes, okay, I think you're getting there. Long-term, yes. So normally, note payable is a long-term liability. And the reason, yes, it's a loan. It's a loan between, that's correct, it's a loan. Now, the thing is, what's the issue here? Usually a loan, remember what we talked about earlier, is used to pay for fixed asset, right? However, of course, this is in the current portion, the current liability portion means that it is a short-term note payable. And normally, note payable is not part of running a business, right? Running operation of business. Remember, working capital, what's working capital again? Working capital is the capital required for day-to-day operations, right? Note payable, when you take a note, a loan from the bank, most of the time, I would say 98% of the time, it's used to buy fixed asset, it's used to invest in something, right? It's not to use for daily running of the business. If you use a note for daily running, meaning you take loans from bank to run your business, means that your business is probably going to be bankrupt because you have not enough cash, right? That's why you're taking a loan to run the business. So no one does that. So in a very pure accounting sense, note payable should be excluded from your CL. So your CL should only include, in this case, accounts payable, AP, not note payable. So in the calculations, actually the more correct method is to only take 266 here. So instead of 389, take 266, right? So this is a very pure accounting thing. So there are two methods here, right? One is you include note payable, which is more the finance part, but actually it's not so correct. And another part where you exclude note payable, which is actually more correct. Okay, so I just want to highlight two different methods here. Both methods will be accepted, right? Um, the more correct one is to not include note payable. So the reason why I like to highlight this is because I know many of you are already working part-time or even working full-time studying part-time, right? So in case you need to do such analysis, and if especially if you're working in an audit firm or even an investment firm, right? If you consider note payable under this net working capital, in case you're ever asked to calculate this, it's wrong. And most of the practitioners in the industry will say it's wrong. So I just want to caution you uh, on this, right? So that you learn the right thing. And then in case you go in the industry, when you talk to your bosses, your managers, you know that this shouldn't be included. Yes, the answer will be different. That's right. Okay. But in any case, let's use what is given here, what's written here. So we include the note payable. So we get this as the net capital spent, and we get a CFA of this. So I strongly encourage you to try to redo this calculation to get the CFA answer because sometimes it can be a bit tricky to get it. So because when I did it the first few times, sometimes you miss out this, you miss that, miss this, miss that. So I highly encourage you to try doing it rather than just look at this example here. Okay. Uh, there's a question here. Is negative CFFA bad? Anyone knows the answer or want to give a try? It's bad. Okay. Yeah. Why? Why? Why is it bad? Yeah. Okay. Generally, yes. I think you get it. That is, it can be bad. Now this 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 kind of like small little funny kind of question usually sometimes it will just appear in like your some subparts in your assessment, right? So yes, okay, I like that last answer, depends. So I think all of y'all get why it's bad, but I want y'all to think also why is it good? Because sometimes when you have these kind of small questions, right, in your assignments, and you need to look at the number of marks. If there are too many marks given, right, let's say it's a 15-mark question. It's so simple. It's negative CFFA bad, and it's 15 marks. It means that you need to answer it depends. You need the good and the bad. Because it's so much marks, 15 marks. Can't be just you say bad and then it's 15 marks, right? So it depends. Okay, so we already know what is bad, and all of you are, are correct, right? That is bad. Now, why is it good? It's because sometimes again, I see a answer here, spend more, which led to a deficit that could be long-term growth. Okay, you are right. You are right that they spend more, but in what situation would they spend more? That's right. Your answer is correct. They spend more. It could be deficit, but it could be uh, long-term growth. Yes, that's right. Okay, I see expansion. Maybe early stage that can't generate. Yes, you're totally right. So both of all of you are correct. So in a sense, it's an early stage, meaning like a startup company, they're expanding, they're like expanding very fast. And so they're spending more, which could lead to a deficit. However, it's for long-term growth, right? You're all correct. So perfect. So um this is the part where I like you to be very careful. When you read questions, right? Look at the number of marks. If it's like 15 marks, 20 marks, you need to know that you need to give both sides. Okay, both, like sometimes the question will not say give both sides of the argument, right? But if you look at number of marks, it's a lot. Please give both sides. So yes, all of you are correct. Expansion phase. Okay, so we have covered a lot about the CFFA formulation. Now, this is the formulation 2, version 2 uh, version. So the previous CFAFA formula is using on the balance sheet, the asset side of things, right? Look at asset side. But remember, since it's a balance sheet, I can actually look at the liability plus OE as well, right? If I look at the liability plus OE, uh, oops. If I look at liability plus OE, it should give me the same CFFA, right? Because it's balanced, right? It's supposed to be balanced. So this is what I'm doing here now, right? I look at the cash flow from creditors. And what does this mean? It means interest paid minus new borrowings, right? So what is the cash coming in, right? From borrowing money from the bank, right? Plus the cash and what interest I paid off. And then because I'm looking at the other side of the balance sheet, I need to consider the cash flow from stockholders or shareholders. And where does this come from? It comes from any dividends that's being paid, which is cash outflow going out, cash out, and any new equity raise, meaning cash coming in because the owners inject cash into the business. Now we have an example here, so don't worry to show what it means. Okay, so using the formulation 2, version 2, what is the cash from creditors? Okay, interest paid. How much interest we paid? 70 here. What is the net new borrowings? Okay, let's look at borrowings. Can you see here? Borrowings has increased over year on year. right? So this is the net new borrowing. So you take this minus this. So we get this. Now, what is the cash flow from shareholders? So we can see the dividends paid. These are dividends paid. And what is the new equity? Let's look at what's the new equity. Can you see here that, let me use a different color. Can you see here that there's new equity of $40 increase? So get this. And your CFA is 87. And it's exactly, can you see it's exactly the same? 87 here as well. Because it's the balance sheet, so it must balance. All right. So you have two ways of calculating CFFA. Version 2, which is what we talk about here, will only be covered in this lecture 1. That's why if you notice, I spent slightly lesser time on version 2. Because version 1, which we covered in very in-depth detail here, right? All this will be again covered and used in lecture 4. So version 1 is actually the main version that we will be using for most of our lectures here. So that's why this is even more important. Okay. Table. There's some self-review questions. Okay, so I think now's a good time to let's take another 7 minutes break. We'll come back at 9:12 before we conclude the last part of today's lecture. Okay. Any questions, feel free to put in the group chat. We will discuss when we're back. Right. Welcome back. So far is the pace all right? Is everyone following the lesson? Yeah. Okay, that's good. Okay. It's good. Okay. So it's good that everyone is still following very well. Let's move on to the last part of today's lecture. So we look at working um, um, more of a ratios part, right? Okay, so the idea is that now we have the financial ratios. So let's think about it first before we go into detail, right? Let's try to think about things. We have a financial ratio. Sorry, not financial. We have financial statement. The question is, are we able to compare the financial statement between companies and maybe between number of years, right? So we want to do some comparison. We want to do some like kind of analysis. Oh, is the company doing well, like last year versus this year, or is the company doing well compared to its competitors, right? Let's say fair price. We want to check. Oh, am I doing well compared to cold storage? So in order to do such comparison, we need to do some analysis. And the analysis includes ratio analysis, which what was the main bulk of the last part of the lecture, and also this thing called standardization of the financial statement. It's not very common, I would say, because it's a very low level. Yes, you can do it, but it's very low level analysis. Ratios are the one that's more high level analysis. So that's why the bulk of the time we'll spend on ratio, less on this standardization of financial statement. Okay, so but what does it mean? Let's try to understand, even though it's a low level of analysis. It means that we want to make it a common size balance sheet and common size income statement. So we divide the balance sheet and income statement by the largest item, which is usually either the total asset for balance sheet and the sales or revenue. So in this sense, we are able to standardize everything in the balance sheet and income statement in percentages. So everything becomes percentages. And so with percentages, we can do comparison already. There's an example here in the next slide to show you how does it look like after we do standardization. So this is the balance sheet, as you can see here. Now we want to standardize it by using the total asset. So can we see that all these are now percentages? It's all in percentage, and from here we can calculate the change as well. Similarly, for income statement, this is a normal income statement, and then we divide it by sales, right? So sales, of course, divided by sales is 100%. Then the rest is all in percentages. These are all percentages. Okay? So that is a small little introduction on standardization, but bulk of our analysis will focus on ratio analysis. And what does this mean? So to better compare the company, we will use kind of a ratio. So I believe most of the ratios or some of the ratios are not new, because it probably covered other causes. But let's try to do a recap as well for those ratios. So the main part about ratio analysis is, of course, calculating the ratios. But I want to emphasize and highlight this point that understanding what the ratio means is even more important than calculating. Why I say this? Because nowadays, right, we have Excel. Of course, more than Excel, we have a lot of tools that help us calculate ratios automatically. Okay, I won't say they're AI tools, but they're just tools that calculate ratio automatically for you. So you just plug in the financial statement, they can calculate any ratios you want for you. And so moving with the time, of course, with our lecture, with the school, yes, calculating ratios are too important because they help you understand, but a lot of the focus would be on understanding what the ratio means. Okay, so I hope that that's the part that you really focus on and try to understand what does it mean, and when you and try to explain the meaning of the ratios in your assignments, because the explanation really can carry a much bigger proportion compared to calculations. Okay, of course, you know, you calculate the ratio wrongly, then your explanation will be off as well. So it's a bit tough. So that's why you do need to know how to calculate, but the focus is still on commenting on the ratios. Okay, so there are a few, 1, 2, 3, 4, 5 categories of ratios that we'll look at. So liquidity ratios are ratios that assess the ability of the company to quickly raise cash to pay its creditors and meet interest payments. So how quickly the company can raise cash, right? So it's very similar to the idea of liquidity we talked about earlier. Financial leverage, so this is different, or long-term sovereignty. It means that it tries to assess ability to meet the long-term debt and continue operation in the future. So liquidity is more short-term. You want to measure how fast, right, you can generate or raise cash. Now, financial leverage or long-term sovereignty is the long-term health of the company, right? How well in terms of financials is the company doing? Okay, so this two is different. Asset management is, are you managing the asset well? Are you optimizing the asset very well? Right? So we'll look at how to calculate this. Profitability, don't need to talk about it. Market value ratio is market indices. So we look at share price, we look at book value to equity, so like various market related ratios or numbers. Okay, so this is a summary. I won't go through because we'll go in detail. Okay, so let's look at liquidity ratio first. So you'll notice there are some like gray explanations. So those are additionally added in my slides. In case you're still using the lecture slides, they might not have this. So I'm just trying to explain, help to explain more about what the ratio means, because this is the focus, as I mentioned earlier. Right? So first ratio, liquidity, is CA divided by CL. Current asset minus divided by current liability. Again, I want to highlight the note payable thing, the issue here. So in case you do not add note payable, it's fine too. If you add, it's not so correct, but it's fine for this module, right? But the correct method is do not add note payable in your CL. Okay, but in this case, they added note payable in CL, which is fine. As you can see here. So what does current ratio means? Usually, a current ratio above 1 is appreciated. Why? It means that there's at least 1 times of the current asset to cover the current liabilities, right? If it's less than 1, means that, hey, you know what? There's not enough current asset to cover the current liabilities. So we want at least 1. Okay, what does quick ratio means? Quick ratio, you remove off the inventory from your CA, right? It's like current ratio, but you move the inventory. And why do you do that? It's because inventory usually is not so liquid, right? So when you see here, inventory is very hard to sell inventory very quickly. If you need cash, remember liquidity ratios want to assess how quick the company can raise cash, right? So if you are very strict, you want to look at the quick ratio, you must remove the inventory, because it's very hard to sell inventory without having a big discount and selling your inventory to your customers. Cash ratio is like super liquid. You only look at cash, right? You don't even consider accounts receivable. Cash ratio is not really used very often. Most of the time, people use current ratio and quick ratio. Okay? Because cash ratio is too strict, right? You just want to look at cash only. Nowadays, most companies do not hold too much cash as well. As you know that cash cannot generate income for you, right? Cash is very liquid, but then it's just sitting there, right? For example, some of you already started working. You know that if you have a lot of cash in your savings account, you're not generating income, right? I think most of you already started like investing small amounts here and there in like stocks, in like things like Tiger, what's that? Is it there's Moo and Tiger Trade? Yeah, so most of you already started some small little trades here and there. So you know that if you just put cash, it's useless, right? It's just sitting there. So that's why cash ratio not very popular. Any questions on liquidity before we move on? So there is a small comment here that if it's too high, it's not good as well. Oh, these things happening again. Not sure why. If it's too high, it's not good as well because, oh wow. Because if it's too high, your current ratio means that you have too much, maybe assets, which include like cash. And when it's too high, it's not good. You are not utilizing the cash well, or have too much inventory, which is not good too. Means that you might have inventory obsolescence. Okay. So now we look at the total debt ratio. So total debt ratio is TA minus TE. What's TA minus TE? It is, what's wrong with this? Oh, so TA minus TE equals to TL, right? Total asset minus total equity equals to total liability. So your total debt ratio is just total liability divided by total assets. Now, there's a comment here. What is total liability that they use here? So total liability that they use is this one, right? This is the total liability they use. Five, no, sorry, not this. This one. So 540 plus 457. Now, the issue with this is why I put this comment here is again similar to what happened previously, where we say note payable should be excluded. Now, account payable should not be considered a debt, right? Account payable, remember what is it? It is relating to, everyone know? Account payable is relating to what? Unpaid invoice, okay. Yes, and it relates to working capital or net working capital. So net working capital is more of a daily operation of the business, right? Not related to debt. So generally it should be excluded, but in this course, it's fine to include, but I just want to highlight to you in case when you're working outside, we do analysis, this should be excluded. And the proper way is to exclude it from your debt. Total debt ratio, okay, that's so it shows you what's the percentage of the co's assets financed by debt, right? Because you're taking total debt divided by total asset. So what's the proportion of debt that's being used to finance this asset? Debt to equity. So debt to equity is total debt divided by equity. So basically, it shows how much is debt, how much is being financed by equity. What's the proportion? Now, equity multiplier is basically just the inverse. Can you see? It's the inverse of debt to equity because you plus one, or you can take TA divided by TE. And what does it show? It gives the proportion of the company's asset financed by equity rather than debt, right? Okay, moving on to more solvency and financial leverage, we have the time interest earned, EBIT. So for EBIT, we just take the EBIT, which is given here, divide by amount of interest, right? So it basically try to show, is the company able to pay its interest expenses, right? It tests the ability of the company to service its debt obligations based on its income, right? Because remember, its debt obligation is largely for interest, so it's check, okay, is it able to pay off its interest? Cash coverage. So cash coverage, um, we use EBIT plus depreciation because you add back the depreciation because it's non-cash. Okay, if you notice, we always add back non-cash. Ability of the co to finance interest expense from its debt, right? Interest add back since it's non-cash. So your cash coverage and your time interest earned is very similar, just that your cash coverage makes a bit more sense because you add back the depreciation. Because depreciation is not really, it's an accounting concept. Okay. Moving on to your asset management ratio, we have three that we want to talk about. Number one, inventory ratio. So inventory ratio. So basically the idea of cash asset management is you want to see how well is your asset used to generate business. Is it being optimized well? So we look at inventory turnover. So what does inventory turnover mean? It means the cost of goods sold, right? COGS here, divided by average inventory. Okay, at this point, I want to highlight what's average inventory. Average inventory is beginning, beginning inventory plus ending inventory divided by 2. Okay, so always use, okay, I'm going to highlight this, always use average inventory if you are being given information for it, beginning and ending. However, in this case, can you see that they don't give you beginning or ending? So no choice, you just use inventory number. But if you see a question that gives you beginning and ending, always use average, right? You need to use average inventory. So inventory turnover tells you the number of times the warehouse being emptied. In this sense, the more you turn over, the better it is, right? However, I want to add that the number of times your inventory turnover really depends on the type of industry you're in. So, when you make analysis and comments, you want to make sure that you look at what is the industry average. This thing called industry average, right? So, for example, a supermarket inventory turnover might be very high compared to a car dealership, right? You don't see people buying cars every day, right? But of course, grocery, everyday people are buying grocery. So you really need to look at what is the industry average. And how do we get industry average? I believe most of your um, who have access to S&P Capital IQ, which is a database for SUSS, or if you are in the finance program, I believe you have access to Refinitiv. So those two databases would provide you the industry averages. So in case you need to use that for your GBA, please reach out to those platforms for information, right? So they are very similar to your Yahoo Finance, but they provide you a lot more analysis because it's a paid platform and it's really good compared to Yahoo Finance. It'll give you a lot more information. So in case you need to get some information, please reach out to those platforms. Okay? Refinitiv and S&P Capital IQ. Of course, if you don't, wait, just want to do a quick check. Have everyone used or at least went into the platform to have a look? No? Okay. So, no, okay. So it's actually in your library database. I can share the link. Is basically if you Google SUSS library database, you'll find it. And you go under S&P. So S&P. I will share it as well in the announcement next week. Capital IQ, right? You Google SUSS library database, you go into this and you just sign in to your account and you will access the information there. Okay. So why I highlight this? Because um, for some years, the GBA, there's some requirements for like a bit more external research, and this platform is actually very useful. So depending on the question, so you need to be very careful. If it requires you to use some external information, please use these two databases to get the industry averages, like what we talked about. Okay. Okay, so day sales inventory or inventory period, basically you just take the turnover, 365 divided by turnover. And what does this mean? It means it tells you the number of days the inventory is sitting on your shelf before it's being sold, right? So days sales in inventory. Number of days is sit on your shelf before it's being sold off. Now, number two, remember we say we have three asset management ratios. Number two is your receivable ratios. Again, we're looking at how fast your receivable is being turned over. So the concept is the same. Credit sales divided by average. I want to highlight again, this important, use average AR. Day sales in receivables, 365 divided by turnover. Is basically how long it takes for you to collect your receivables. So you notice it's kind of the same pattern, right? You just pick different numbers. At this point, I want to highlight is credit sales. Sometimes question will give you cash sales and credit sales. So this is important. If you are given the split of both cash and credit, please ignore cash. Cash sales does not contribute to AR, right? Does not contribute. AR is what? AR is accounts receivable, this part, right? Only credit sales contribute accounts receivable. So please only take credit sales, no cash sales. Uh, Next, we have your payables ratio. So this is the third one of the set that we talk about. Payables ratio is your payables turnover, which is cost of goods sold, divided by average accounts payable, average. This one here, average. Of course, in this question, we only have one, so we just put one. Day cost in payables, you see it's the same concept. We just take 365 divided by accounts payable turnover. It explains to you, how long it takes you to pay your suppliers, time between receipt of inventory and payment of it. Now, I do have a question here. For day cost in payables, so this one, day cost in payables, and day sales in receivables. If you are the company, which one do you want it to be very large and which one you want it to be very small? So the question is, you have day sales in receivable, day paid in payables. Which ratio you want it to be as large as possible for optimization and which one you want it to be as small as possible. Okay? Okay. So I see both, it seems like both ratios must be as small as possible. Okay, so let's think about it. Day sales in receivable as small as possible. What does day sales means? How long it takes to collect the receivables. So how long it takes for you to collect money from your customer, right? Okay, so you're all of you are right. You want it to be as small, right? You want to collect it faster, right? You want the money faster. You want to collect it faster. Okay, that's correct. Perfect. Now let's go to the next one. Day cost in payables. Now, I think I saw a right answer, which is actually as long as possible. Correct. I think more of you are getting it. Because, okay, what does day cost in payable means? How long it takes you to pay your supplier, right? So as the business, you are the business, wouldn't you want to pay your supplier very late? Like pay them 30, 40 days later, right? The longer the better, right? Because you don't want to pay them so fast, so you have more cash with you, right? I mean, it's selfish, it's not correct, but optimally, you want it to be as long as possible. So I hope you can understand for day cost in payable, the longer, the better for the company, right? Because means that you have more bargaining power. If the company has bigger bargaining power, your day cost in payable is longer because you have bargaining power to say, you know what, I don't want to pay you in 30 days, I pay you in 40 days. Rich dad to poor dad in logarithms. Yeah, you can see there's a tension here, right? So the tension being your bargaining power of suppliers and your bargaining power of your customers, right? How strong are they to bargain and to push you to pay? If their bargaining power is weak, you are a big customer, yeah, you don't pay them so fast. Now, continue on more asset turnover ratios. We have our total asset turnover. So we just want to see what's the total asset count turnover with the six sales divided by total asset. Basically shows how efficient your total asset is being used to generate sales, right? So you just use total asset aggregate. So aggregate count measure. Capital intensity, you just take one divided by total asset turnover, or you just flip the TA divided by sales. So when you flip it, it gives you the amount of capital need per dollar of revenue. So how much asset you need to generate $1 of sales. Okay, your profitability ratio. This one I'll go a bit faster because most of the time this is what people are the best at. Like from the last like even the most of the time people can explain this very well because profitability is something everyone likes to look at, right? So profit margin, what's profit margin? So it's how much net, so it's bottom line divided by sales, right? Bottom line divided by top line. So net income divided by sales. So what's your margin like? What's your gross profit margin? So gross profit margin is very interesting. It's gross profit divided by sales. But actually, it shows what? It shows this is a very important concept. It shows the pricing power of the company. So what does this mean? It means that a company that has very strong pricing power can actually price the product and earn a lot of gross profit margin. One example of this is your food industry. Things like restaurants, especially if you go to like high-end restaurants, you can pay for simple dish, right? Let's say a pasta, but they charge you at $40. But you simply know that maybe the pasta that you get would cost, if you cook it yourself, maybe it costs you $5, $7, or $8. Can you see that their pricing power is so much, right? Another example, of course, is like luxury goods, right? Like maybe your branded bags. Of course, the bag doesn't cost 3,000, 4,000 to make it probably does cost $300 to make, right? So the pricing power is very strong. So gross profit margin really shows how strong of pricing power do you have. Yeah, it can be a very niche market as well. Yeah, you're right. So if it's very, like for example, Apple laptops, Apple is the only one that creates this, right? Unlike Windows laptop, you have so many brands. Windows, you have like Asus, you have all your what's that? Other kind of Windows laptop that all the other brands, right? So Apple is very niche. That's why they're able to price it very high, and people still buy, right? I think many of you are also using like your MacBook Air, your MacBook Pro, etc. Yeah, it can be a marketing strategy as well. So I like how you guys are pulling in like different ideas into this finance ratio analysis, and that's what we want to do, right? When we comment on ratios like gross profit margin, try to pull in ideas that you have learned from other modules, like things like marketing strategy. Is it a niche market? That's why their pricing power is so good, right? And so we want to pull in this kind of information, and that's how you get a very comprehensive kind of analysis instead of just um, the gross profit margin is 41%. Okay, so what you want to pull in more information. EBIT margin. So EBIT margin, EBIT divided by sales. Basically, it's your earning before interest and tax. Why people like use EBIT margin is because sometimes gross margin can be manipulated, right? So EBIT margin generally is better. And in what cases? In cases where the company has different product lines, right? Different core and non-core product lines. I want to give you an example here. Imagine SIA, right? I think all of you all know what's SIA. Their main business is to provide commuting, right? Like plane flights, right? Flight commuting. Now, some of you all might know, some might not know, but SIA also has a engineering side of their business. They do engineering, building of aircrafts, repairing aircrafts. And sometimes this portion of business actually kind of only contribute 20, not 20, not even 20, maybe 10%, 5 to 10% of their total revenue. So if you use gross margin, usually it's aggregate, right, of everything. So it might not be so representative. That's why we want to use EBIT margin instead. So there's a bit of explanation here, right? In the between operating margin, EBIT, and how is it different, right? Which is very similar to what I explained, because a lot of the companies usually has unrelated, kind of non-core activities here. There's a bit of explanation on why a lot of companies like to use operating margin instead of net income. So net income, remember net income is the last item, almost the last item in the profit and loss statement. And this last item, of course, already include interest, depreciation, things that you know should not be included. Why? Remember, depreciation is non-cash. And number two, interest is relating to the capital structure of the company. So I'd like to highlight here, what does it mean? Really, capital structure means that if the company takes on more debt, you have to pay more interest, right? However, it really depends on maybe what stage the company is in. Maybe it's in the early growth stage, you need to take on more debt. So you should not penalize or assess the company just based on net income, right? That's not good. So you should use operating margin or EBIT. There's a few more profitability ratios. Your return on asset. That's usually your net income divided by total asset. How much the co earn per dollar of asset, right? So this is slightly different from your sales divided by total asset, right? That one is sales figure. Now this is more earning, how much they earn. Return on equity. Again, quite similar. Net income divided by total equity. So how much the shareholder earns. Okay. So in terms of return on equity, you need to be careful because a higher debt amount, if you notice, if your debt is high, your equity is low, right? Because there's more portion is relating to equity. However, if you have higher debt, it depends on what economy is it. We'll look at example in lecture 3, where you can actually see the numbers. When the economy is doing well, if you have more debt, the company will do very well. However, if you have a lot of debt, but the economy is doing badly, because you still have to pay interest, even though you are doing badly because the economy is doing badly, this will make your return on equity even worse. You'll pull it down even more. Okay, we have some market value measures. So market value measures, they relate to more like price per share. So earnings per share. What do we do? Earnings per share. So we have earnings. Sorry. So we have PE ratio, which is price divided by earnings per share. So we have the earnings per share is this. You are given the price per share of 88. So you take 88, which is price per share, divided by earnings per share. So 8 times. So how much more the investors willing to pay, right? Because your price is based on market, earnings is based on the accounting numbers, right? So when you compare price and earnings, you can see how much more the investor is willing to pay. So if it's high, it means the stock's overvalued, right? And maybe it's because they expected to grow a lot more. But as an investor, maybe you want to find an undervalued stock. Usually you want to find something that's undervalued. Then you buy the undervalued stock so that you can earn a profit. Price to sales, you just take price per share divided by sales per share. So you remember divide by the number of shares here. This is the explanation is similar to this, to PE. Market to book value, you take the market value per share, right, which is given in the question. And what's the book value? So how do you calculate book value? Total equity divided by number of share outstanding. You get this is the book value per share, and then you calculate what is the market to book. So if the price is higher than the book value per share, means that the company is overvalued. So you should sell. If the market to book value, the market is below the book value, undervalued, means that you should buy. So if the price per share is more than the book value per share, there's a comment here I want to highlight that, you know what, it could be some intangibles that are not found in the financial statement. So these intangible assets and stuff will actually contribute to the price of the asset. That's why you see that the price per share is higher than the market value, book value, because the intangibles are not included in the book value. And example of these includes things like R&D. So R&D is not an intangible that is included in the balance sheet. Okay, so yes, you do a lot of R&D. Maybe eventually your R&D will produce a very good product. But in the process, before it produces a product, you'll not include it at all in your financial statements. And because of this, your price per share, because your investor know that you're doing this R&D, and maybe in 2 months' time, your new product will appear on the shelf. But your investor know about this, and that's why they increase the price in the market. However, in your financial statement, of course, you cannot disclose this in your financial statement. You cannot say that this R&D has produced a product, right? It has not produced a product yet. Okay. So we have this idea of a DuPont analysis. So what's a DuPont analysis? So DuPont analysis is basically ROE. But the idea of a DuPont analysis, right, is to split the ROE up into 3 components here: profit, financial management, and leverage. So efficiency and leverage ratios. So you split them into 3 components and try to determine which component, this, or this is driving the ROE for the company, right? Which part is making the ROE go up? So that's the purpose of a DuPont analysis. You want to determine which is driving, which component is driving it. Now, of course, if you can see here, can cancel, 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 cancel. It gives you net income divided by. Okay. So these are just some repeat of what it means. Can just have a look at it. It's an example of the DuPont analysis being done. I'll not be going through this. Okay, last but not least, I want to cover this thing called determining determinants of growth. So what does this mean? So we know that when a company, okay, so before we go into all this detail, let's try to understand this first. We know that when a company retain money in the company, right? So that means it does not distribute the money out as dividends. It retain the money inside the company. This money that's being retained can use to grow the company, right? They can use the money to buy more assets. They can use the money to do R&D investments. So this money that's being retained is being used to grow the company. So to determine this thing called sustainable growth rate of G, we simply take ROE multiplied by retention rate. Retention rate means what's the amount of money that's retained. And how do we determine retention rate? Is 1 minus dividend growth payout. Makes sense, right? What? Remember, you have a pie. If this is dividends, DIVI, right? This is dividends here. This is dividends. So whatever that is not dividends, which is here, is being retained, right? So that's why it's 1 minus dividend payout. And how do you determine dividend payout ratio? Dividend divided by net income, or dividend per share divided by earnings per share. So sustainable growth rate, G, the rate is the growth rate of a company without the need to use equity or debt. So basically whatever that the company generate that can help the company grow. But it's not relating to equity or debt. It's just purely on the income that they earn. Okay, I'll pause here. Any questions so far? Are we good with the ratios? I think that's all for ratios. Maybe it's a bit heavy, especially towards the end. Don't worry, if you do have any questions as you review the slides again, feel free to drop me an email. Usually I reply email pretty fast, so don't worry about that. If you have any questions along the way when you review the slides yourself. Okay, so that's all for ratios. I'll not really go through this. Why financial statement? Why evaluate financial statement? Who are stakeholders? Benchmarking. Benchmarking and peer group analysis. Basically, I'll not really talk about this because I have a good slide. This slide here that I'd like to talk about. So what's this slide talking about? So in your GBA or your TMA, whenever you're asked to do a kind of analysis, you need to take into account a few steps that we look at, right? So these are like the checkpoints that make sure that when you do a financial statement analysis or credit analysis, which both are the same, you need to make sure that focus on the large item and large changes that constitute a large percent of balance sheet. So focus on large item. Do not talk about small stuff, right? Compare the ratios across time, meaning 2-3 years. Okay. Take into account industry impact and social political factors. So what does this mean? These are like things like your marketing strategy that we talk about. Is it a niche market, right? Are there any issues in that country that is impacting the financials? Try bringing context and reason. we also discussed a little about this, like imagine Apple. So, oh, Apple is a very niche product, it has very strong reputation, which is why the gross profit ratios are so high. Yeah, these are some context and reason. I've highlighted using the Porter's 5 model. This is a recommendation. You don't have to use Porter's 5. If you want, you can use other models. Um, if you don't know what's Porter's 5 forces, just do a quick Google. I think maybe if a year two, you might have done it before in, let's say, your strategic management courses. Um, I hope everyone has done it. Yeah, everyone knows what's a Porter's 5. Okay, last but not least, given the interest of time, last but not least, comment on one of exceptional items, right? The Black Swan event. This is very pertinent to things like, I like to highlight SIA. Why I like to highlight SIA? Because we know that we have gone through the whole COVID situation, and COVID is a black swan event, right? So black swan event means that it only happen like once in a decade or too many decades, right? And so for such black swan event, we need to make sure that we adjust the balance sheet or adjust the numbers and ratios or make some comment. If you don't want to adjust, make some comments to say that yes, okay, the profit dropped like crazy during COVID, but this is a black swan event, right? It's only because of COVID that's why the ratios dropped so badly. So we need to do some comments, right? And one of exceptional items. Understand the impact of impairment. So those that have taken your accounting module, you might know what's impairment, some write-off and recurring expense on items. So things like write down, um, and how it impacts your net income, right? Because impairment is an expense, it impact your net income, right? So this slide is very important. I want to bring your attention to this. Whenever you do financial statement analysis, I hope you can go through, make sure that all the steps are being covered here in your financial statement analysis. Okay, I think we have a question. How do you get the gross profit? Let's go back to gross profit. Okay, how do you get the gross profit? So gross profit, you simply take this. 2311 minus 1344. Sales minus cost of goods sold, as you can see here. Okay, let me know if you can't get this gross profit. Yeah, most welcome. Okay. Okay, I think that's all we have for today. So there are a few self-review questions you can have a look at. I want to also highlight, I've added this example here, just a self-review example. And what this example does is, I want you to focus on the explanation of things like the SWOT analysis, um, comparative analysis, and important part is this part on financial statement adjustments that we talked about like earlier, as well as like peer selection and this part here, and all the way forward. Income statement. So basically, this is what I have written as an example for you to kind of understand the depth of analysis that's required for financial statement analysis. Because in the last few sessions that I realized that maybe you are not so familiar, okay, how deep should I analyze the company, the financial statement analysis? So this is almost like I would say A grade kind of thing. Of course, some of it can be very technical, but don't worry too much. Try to just understand more of the concept and how it's being written. And this is a very good guideline when you do financial statement analysis. So I just added this explanation here for you. Okay. And then you can understand. So basically, this is a valuation of a company that's listed in the SGX. So this is something that I've done. Okay. And there's some appendixes. And yeah, so actually that's all I have for you. Any questions so far? Any comments, any feedback that you'd like to share? of the module? Does everyone like the module so far, or like, oh, it's very heavy? Just pause the recording.